All right, let's just jump right into it. Think about this. One of the most fundamental things in your life, the actual cost of money, has been completely rewritten over the last couple of years. And you didn't get a vote. You didn't even get a memo. But you are absolutely paying the price.
Have you felt it? That sudden squeeze? Maybe your mortgage is suddenly punishing? It's the same house, you have the same job, but the numbers just don't feel the same anymore, do they? Or maybe it's your rent just climbing and climbing, squeezing your budget tighter every single month. It feels like the financial ground is literally shifting under your feet.
It really makes you wonder, right? Who's actually making these calls? Who's the one deciding that all of this has to happen? And, maybe the most important question of all, why didn't you get a say in any of it? Let's pull back the curtain and see what's really going on here.
So, the people who are pulling these economic levers, they are probably not who you think they are. They are the unseen architects of the financial world that we all live in. But here's the thing that's so fascinating. We're not talking about some cartoon villains, scheming in a smoke-filled room. The reality is way more mundane, and honestly, in some ways, it's even more unsettling.
They're economists, unelected experts, or technocrats in plain-looking suits just staring at spreadsheets all day. Their main job? To stop the economy from completely crashing and burning. They sit on the boards of these incredibly powerful places like the Federal Reserve or the European Central Bank, and they're the ones who have to make the really tough calls.
Now, to really understand the kind of power they have, we kind of have to rethink what money even is. It's not just paper or numbers on a computer screen. Money is really a claim on time. More specifically, it's a claim on your future work. See, when you take out a loan, you're not just borrowing cash. You're borrowing your own future effort to pay that loan back. So the interest rate, it's literally the price of tomorrow. And this brings us to the two very different worlds this creates. When interest rates are low, the future's cheap. It's easy to pull tomorrow's potential into today. And it feels great. The housing market booms, startups pop up everywhere, we all feel a little bit richer. But when rates are high, the future becomes expensive. Borrowing becomes painful, and the entire economy has to hit the brakes. And that right there is the catch. Those good times, all that cheap money, it has a consequence. When you have too much money being pulled from the future to chase too few things in the present, you get the one monster that central banks were built to fight: inflation. So how does this actually work in the real world? It all starts with a single vote by a pretty small committee on what's called the base interest rate. And as you can see, that one decision creates this massive ripple effect. First, the commercial banks react and they adjust their own loan rates. Then you feel it when your mortgage and your credit card bills suddenly change. After that, businesses start to slow down. They freeze hiring, they rethink their plans. Even whole governments feel the squeeze. It gets harder for them to borrow money. And all of that stems from one meeting that you weren't invited to. And once you understand that massive impact, you start to grasp why these economists have such an impossible job. They are constantly being forced to choose, not between a good option and a bad one, but between two different kinds of pain. So what is this impossible choice? Well, on one hand, they could just let inflation run wild. And that's like a slow, creeping pain that just silently eats away at everyone's savings and wages. Or, on the other hand, they can hike interest rates. And that is a sharp, immediate pain, deliberately slowing the economy down, which, can cost people their jobs and their businesses. So this is the most crucial point. There is no easy, neutral path forward. Doing nothing is a choice, and it has consequences. Acting is also a choice, with different, more targeted consequences. No matter what, someone always pays the price. Now, to guide this massive decision, they're judged on their ability to keep inflation near one very specific number, a number that sounds incredibly scientific and precise: 2%. But why 2%? Where did that number even come from? Is it based on decades of complex economic modeling? Is it some perfect golden number for keeping the economy stable? Nope. The reality is, nobody's really sure. It actually started as this kind of off-the-cuff comment by a central banker in New Zealand back in the late 80s. There's no grand theory behind it. It's basically just tradition. It just stuck. And now entire economies are steered by it. And when you're steering the economy with such a blunt instrument, you're going to create collateral damage. Because the pain of fighting inflation is never, ever distributed equally. The first people to feel that squeeze are always the borrowers,
We're talking about young people who are just trying to buy their first home, small businesses that rely on loans just to operate and grow, even governments that have large debts. Basically, anyone who needs to borrow money to build their future gets hit the hardest.
Meanwhile, a completely different group quietly benefits. People who already have cash savings, suddenly they're earning more interest. Those who own their assets outright are shielded from the pain. And of course, the lenders, they make more money. So higher rates act as this slow, quiet reshuffling of wealth away from borrowers and towards savers.
Which brings us right back to that original question. Why don't you get a vote in all of this? Well, the uncomfortable answer is that the system is designed that way on purpose. History has shown over and over again that when politicians have direct control over interest rates, they tend to choose short-term comfort, cheap money, to win elections, and that often leads to long-term disaster like hyperinflation. So we handed the keys to the technocrats instead.
And that leaves us with this final, lingering question. In a world that has become completely addicted to cheap money, raising rates isn't just a technical adjustment. It's a conscious decision about who has to bear the burden for stability. So how long can they pretend they're just adjusting a number and not explicitly deciding who wins, who loses, and who gets hurt first? Because whether you voted or not, you're already paying for the answer.